Drop a like and do share. Leave your comments and do not forget to subscribe for more videos.
Hello students, welcome to Edupedia.com, your online gateway to the world of invaluable knowledge. During our last discussion, we tried to understand the concept of the present value of the future stream of uneven cash flows with the help of a numerical, wherein an investor, Mrs. Jenny, had been provided with an option of receiving 1000 USD, 1500 USD, 800 USD, 1100 USD and 400 USD as a stream of future uneven cash flows for 5 number of years against a required rate of return of 10%. After undertaking the calculations, after converting these future stream of uneven cash flows to their respective present value, we summed total all the present value of the such future uneven cash flows and arrived at the figure that the present value of such future cash flows is 3748.5 USD. We also tried to calculate these present value factors of 0.909, 0.826, 0.751, 0.683 and 0.621 with the help of two methods. That was, first one was a conceptual method and second one was a straight cut method, wherein we resorted to the present value factor tables. Now students, before signing off, we promised to take up a case of a capital budgeting decision wherein we were trying to apply the concept of the calculation of present value of the future stream of uneven cash flows in the case of an long-term capital budgeting decision condition. So let's take up this particular discussion with the help of again a simple illustration. I am using the word simple illustration because the illustration which we shall be discussing right now is really very simple from the point of view of capital budgeting decisions, because later on when we discuss the actual chapter on capital budgeting decisions in a full-fledged manner, we shall see that the real life capital budgeting decision calculations or conditions are not as simple as they might be seen right now. But over here my main intention is to make you acquainted with the process of the NPV calculation, why exactly NPV is important, and just to give you a brief idea regarding the net present value or the positive net present value creation, which can easily be calculated with the help of the present value of the future stream of uneven cash flows formula. And we shall see that how exactly NPV goes on to create a long-term wealth and value for the stakeholders and the overall company. So students, let's start our discussion with a simple illustration dedicated to capital budgeting decision. The illustration says that there is a finance manager of a company who is planning to purchase a machinery against a cost of 20,000 USD. The cash flows expected to be generated from the machine in the next 5 years are as follows. So just by looking at these 4 or 5 lines, we can conjure that the finance manager of company is planning to purchase a machinery. He is planning to invest the financial resources of the company into the purchase of a machinery whose initial cost happens to be 20,000 USD. The initial cost of the machinery happens to be 20,000 USD, which the finance manager is expected to spend, or he is expected to commit right now at present at T0. Against this current commitment of 20,000 USD at T0, the cash flows which are expected to be generated from the machine in the next 5 years are as follows. Obviously students, over here, as I have already told at the beginning itself, that it's a very simple example. Obviously, if capital budgeting decisions are not taken up for 5 years, at least they go on for 10 years, 12, 15 years. But since this is just a rudimentary example, this is just for introduction, just to make you people acquainted at how exactly the present value calculation leads to the creation of an NPV, or actually the present value calculation of the future stream of the uneven cash flows helps the manager in assessing whether or not a particular investment decision into question can lead to the creation of NPV or not. Because I've already given you a brief introduction to the fact that if a particular asset or a particular project is not creating a positive net present value, then the particular asset should be outrightly rejected, and rather it should be accepted only when a particular asset or a project is capable of creating a long-term net present value, which is eventually going to create the value for the firm. So how exactly NPV calculation may be given effect with the help of the present value or the future uneven stream of cash flows can be affected to, that we shall be explaining and try to understand with this particular very simple example. So now 20,000 USD happens to be the initial cost outlay for the machine if it has to be purchased at all. The expected economic life is that of 5 years. The expected life which can be obtained from the machinery is that of 5 years. So across 5 years, the machine is expected to generate these stream of the future cash inflows. So for the first year, the machine will be flowing in 12,000 USD, for the second year 8,000 USD, for the third year 15,000 USD, for the fourth year 7,000 USD, for the fifth year 3,000 USD. So now the thing shapes up like this, like that initially the manager will have to invest or pay for the asset an amount of 20,000 USD, and for the next 5 years these are the stream of the cash flows which are expected to be earned by these assets. I'm using the word expected because we all know that business and assets, they work in a very unpredictable business environment wherein nothing can be said for sure. So whatever cash flows we talk about, those cash flows are not sure shot cash flows, but they are probable cash flows or they are expected cash flows. So the future cash flows which are being expected by the finance manager to be generated from this particular asset happens to be 12,000 USD, 8,000 USD, 15,000 USD, 7,000 USD and 3,000 USD across a time frame of 5 years. Now, if the required rate of return is 10%, suggest if the machinery should be purchased. Now students, over here I would like to draw your attention towards the point. Once again, required rate of return is 10%. At this juncture, let me tell you that the required rate of return in the case of capital budgeting decisions are usually the cost of capital, but more about it when we shall be discussing the chapter full-fledgedly. Right now, let me just give you a very elementary introduction to it. The required rate of return is also known as the hurdle rate or the bare minimum required rate of return from the asset. It is known as hurdle rate because this required rate of 10% or any percent, as the case may be. Since over here we're talking about 10%, so let's talk about 10% in this particular case. So it means that 10% happens to be the bare minimum rate of return. Once again I repeat students, it is also known as the hurdle rate. Hurdle means it is the bare minimum rate of return which the asset will have to generate. It means the viability of the purchase of the asset, or in order to justify its own presence in the balance sheet of the company, the asset will have to return or generate a return of minimum 10%. So 10% will be the discounting rate. So against a discount rate, against a hurdle rate, against a bare minimum rate of return of 10%, it has to be studied whether or not the asset is being justifying its own presence in the balance sheet. So how exactly will the asset justify her presence? So against a discount rate of 10%, justification is studied in the light of the NPV or the net present value. So against an discounting rate or a hurdle rate or a bare minimum rate of return of 10%, the asset shall be justifying its presence if it is earning a positive NPV for the company or a positive net present value for the company. So what is the meaning of net present value? A very layman's term, net present value is generated when the present value of the future cash inflows are in excess of the cost of the investment of the asset. So this excess of the present value of the future cash inflows up and above the cost of the asset has to be studied in the light of 10%. Students, again, the basic idea remains the same. This 10% is a basic required rate of return. This 10% is a base rate. It is the hurdle rate. It is the bare minimum rate of return, and this is also discount rate. So whatever cash flows, whatever uneven stream of cash flows we are talking about, this stream shall be studied in the light of the bare minimum rate of 10%. Against the minimum rate of 10%, we will study whether or not the asset is justified, the asset is required, or whether or not it is yielding for the company, it is beneficial for the company. So it shall be beneficial for the company only when at the discount rate of 10%, it is being studied that the asset is generating a net present value from these cash inflows which are a futuristic amount and their uneven in nature. They cannot be even, they are always uneven in nature because the business is operating into an unpredictable environment. And this present value of these future cash inflows should be studied in light of the fact that against a 10% variable minimum rate of return, whether the present value of these future stream of uneven cash flows are more than the cost of the asset, less than the cost of the asset, or equal to the cost of the asset. I hope this brief discussion is clear, student. If you understand this thing right now, so I can assure you that when we shall be discussing the more complicated aspects in the capital budgeting decisions, the basic idea shall help you in understanding those more complicated or more demanding scenarios. Now let's look at the solution. Again, as per the question, the cash outflow at present or T0 is 20,000 USD. We have just discussed that the cash outflow at present or T0 is 20,000 USD, which the finance manager is expected to invest. Against this 20,000 USD cash outflow, the future stream of cash inflows we have just seen, it is 12,000 USD for the first year, 8,000 for the second year, 15,000 USD for the third year, 7,000 USD for the fourth year, and 3,000 USD for the penultimate year or the fifth year. Now we need to find out the present value of the cash inflows at 10%. This is absolutely identical to the last numerical of Mrs. Jenny, which we saw that she was also having a future stream of the future cash inflows which were uneven in nature, and they were being discounted or they were being reduced to their present value using a 10% discount rate. The same process we shall be undertaking over here also, with a bit of a difference that we have to study the present value of the future cash inflows in respect to or vis-a-vis the current cost of the investment. Now the same calculation goes like this, which we just saw in our last discussion, that the present value is 12,000 upon 1.10 to the power of 1, 8,000 upon 1.10 to the power of 2, 15,000 upon 1.10 to the power of 3, 7,000 upon 1.10 to the power of 4, and 3,000 upon 1.10 to the power of 5. So the present value of the future cash inflows and benefits are 12,000 into 0.909. I don't want to repeat myself, students, but this is the same calculation. We can also show it as 12,000 multiplied by 1 upon 1.10, or 8,000 multiplied by 1 upon 1.10 to the power of 2, or 15,000 multiplied by 1 upon 1.10 to the power of 3, or 7,000 multiplied by 1.10 to the power of 4, and for the last year 3,000 into 1 by 1.10 to the power of 5. So again, either we can go by the conceptual framework by dividing 1 by 1.10 to the power of 1, or dividing 1 by 1.10 to the power of 2, dividing 1 by 1.10 cube to the power of 3, and then multiply the variables by 12,000, 8,000, 15,000, so on and so forth, which will ultimately give us 0.909 multiplied by 12,000, 0.826 against 8,000, 0.751 against 15,000, 0.683 against 7,000, and 0.61 against 3,000. We can either go by the elaborated framework, or we can readily make reference to the present value of the future lump sum tables, pick up the variables from the table, that is the present value of $1 against the required rate of return of 10% across 1 year, 2 year, 3 year, 4 year, 5 year. We shall be getting these figures directly from the table as well. We can fetch these figures from that is the present value of the future lump sum values from the tables directly, and can multiply it by 12,000. So whichever is convenient, we can take this up, we can make use of it. Finally, the present value works out to be 10,908 USD, 6,608 USD, 11,265 USD, 4,781 USD, 1,863 USD. So where did we get these figures from? It's quite simple. 12,000 multiplied by 0.909 plus 8,000 multiplied by 0.826, that is 6608, plus 15,000 multiplied by 0.751, that is 11,264, plus 7,000 multiplied by 0.683, that is 4781, plus 3,000 multiplied by 0.621, that is 1,863. So the sum total of the present values of the future stream of uneven cash flows works out to be 35,425 USD. I once again repeat, student, after adding up the present values of the future stream of the uneven cash flows, we are getting the present value at 35,425 USD. That is the present value. It is a 35,425 USD represents the present value of the future stream of the uneven cash flows. So these are the future stream of the uneven cash flows which we have tried to convert to the respective present value against a discounting rate of 10%. Now, students, now pay attention. Till now, things were quite simple. Of course, what lies is simple at the same time, but now let's try to understand the concept which shall help us in the future. It is interesting to see that the present value of the future benefits are more than the cost of the asset. Now, students, it is interesting to see that the present value of the future benefits are more than the cost of the asset. We have already discussed a few minutes ago that against a bare minimum rate or against a hurdle rate of 10%, we have to study whether or not the asset is justified in the firm or in the balance sheet or not. So the word justification technically means that we have to see whether or not the particular asset in question is capable of creating a positive net present value or not. So once again, students, the term justification has to be seen in the light of the fact that whether or not this particular asset is creating a net present value for the business or not. So if the net present value has not been created, such an asset should not be shown any interest into, or if it is created, such an asset should be purchased. So how to see or how to ensure that a particular asset is justifying? So this justification comes from the fact that the present value of the future cash benefit should be more than the cost of the asset. I once again repeat, student, this justification comes from the fact that the present value of the future cash benefit should always be more than the cost of the asset. So if this is the criteria of justification, so is this criteria being fulfilled over here? We are happy to say that of course this criteria is being fully complied with, because the present value of the future cash inflows, as we have just seen, it is working out to 35,425 USD. 35,425 USD is the present value of the future cash inflows against the stream of the future uneven cash inflows. So 35,425 USD is more than the initial cost of asset of 20,000. We have seen that the initial cost of the asset used to be 20,000 USD, against which the present value of the future cash inflows worked out to 35,425 USD. Once again, students, against the initial cost of 20,000 USD undertaken at T0, the asset is generating a present value from the future stream of uneven cash flows to the extent of 35,425. So it means that benefits are certainly exceeding the cost of the asset. It means that benefits are certainly exceeding the cost of an asset. So by how much is the benefit exceeding? So the benefits are exceeding by 15,425. So how did we get this 15,425? So 15,425 has been obtained by subtracting the present value of the future benefits, and it is a difference between the initial cost of the asset. Rather, we should say that the initial cost of asset, that is 20,000 USD, is being subtracted from the present value of the future cash inflows, which works out to be 35,425. So the residual amount, that is 15,425, that crops up as the net present value. So now, students, it was a positive NPV. So is this NPV positive? Of course it is positive. The NPV is positive because the present value of the future benefits are exceeding the cost of the asset. Had it been the other way around, it would have been a negative NPV or a loss in value. So had it been the case wherein the present value would have been the lesser than the cost of 20,000 USD, the asset should have been outrightly rejected. But since over here it is working in favor of the asset, we are finding that the present value of the future cash inflows are exceeding the cost of the asset to the extent of 15,425. So this 15,425 USD is certainly creating a positive value for the firm. So this 15,425 dollars, it represents the NPV or the net or a positive NPV. Now the question arises that how is 15,425 NPV creating a value? How is it possible? How can we say that 15,425 dollars is creating an NPV? So over here, students, try to pay some attention. When we converted the present value of the future stream of earnings, exactly what did we do? We took N into consideration. N was the number of years. So one thing is for sure, that whatever investment we have to make, the investment has to be made at T0. The investment has to be made at present. That is 20,000 USD has to be committed, or it has to be paid at today's time or at the present value. But the benefits won't be received at the same day. just recall my discussion on the revenue receipt and capital receipts. Had it been a revenue expense, then the cost and benefit would have been matched against the same financial year. But since it is a non-revenue expense, since it is a capital expenditure, we all know that capital expenditures go on creating a revenue which stretches across time frames. So it is not restricted to only 1 year. It is not restricted to the current year only. Rather, it goes along for the next 5, 10 or 15 years. And whenever we're taking help of the present value calculation, in effect what we are doing, can you just apply your mind in understanding that in effect what we are doing, what exactly is the rationale behind converting all these future stream of uneven cash flows to their present value? The simple thing is that the moment we are converting the future stream of the uneven cash flows to their present values, it means that we are dragging the future back to the present. We are dragging the future back to the present. We are reducing the future cash flows to the present value, and we are hypothetically giving a feel that in the same year in which the expenditure has been undertaken, it is the same year itself wherein the entire benefits has been obtained. So try to understand this point very clearly, students. The moment we are reducing the future stream of uneven cash flows to their compatible or to the comparable present value, what exactly is the feel we are trying to give? Exactly the feel which we are trying to give is that hypothetically, I'm using the word hypothetically because this is not what is actually being done. We are somehow, by using the discounting method, somehow by using the present value concept, we are reducing the future time frame to its comparable value of the present. We are reducing the future to its comparable value at the present. Why am I using the word comparable? Because now it must be clear to you that the moment we are reducing the future values against a discount rate to their present value, what we are doing? We are adding it up. We are summing up each and every present value of the future cash flows. The moment we are adding 10,908 USD with 608 USD with 11,265 USD, in effect what we are doing? We are adding up the present value of the future cash flows of each year till the nth number of year for which the economic benefit is expected to be realized. So for the moment we are adding up the future stream of the cash flows, it means that we are adding up each and every present value of the future cash inflows for the n number of years in the future. The moment we are adding up, it means what? We are adding the present values of each and every year. We are taking up individually the present value for each year, and then by adding it we are arriving at the figure which is the present value, which is a sum total. It means this, after adding up, we are arriving at the present value which is a sum total of all the years, all the number of years for the future. The moment we are adding up the present value for all the years in the future, it means that we are reducing the entire set of the future years to one lump sum figure of the present year, after which we can make the comparison. So try to understand this thing very clearly, students. If you understand this thing now, understanding the capital budgeting decision will be very simple for you. Try to get this thing in your mind. It is a very simple thing. I already mentioned that at times you will feel that present value calculation is more miraculous than the future value calculation, because present value calculations more often than not gives finance manager a very potent weapon by the help of which he can reduce the future values to the present comparable value. I have been using the word comparable for quite a number of times. It is exactly now when you will understand the meaning of the word comparable, because as we know, we are doing business on a going concern basis. Firms are operating on a going concern basis, so everything has to be looked up into a distant future. But of course the future cannot be predicted with geometric precision, but somehow some estimation has to be made if the business has to be taken up in a forward note. If the business has to be taken forward, then some sort of an future looking or future prediction has to be done. So now, with the help of the present value, what we are doing, once again students, whatever future cash flows, future stream of cash flows that are expected to be generated from this particular asset, with the help of the present value, we are reducing each and every future value to its comparable amount of the present. Point number one, the moment we are dividing 12,000 by 1.10 to the power of 1, 8,000 by 1.10 to the power of 2, 15,000 by 1.10 to the power of 3, 7,000 upon 1.10 to the power of 4, 3,000 upon 1.10 to the power of 5. It means what? Number 1 point, we are reducing the future values for each year individually. Number one, future values of 12,000 for each year. That means for the first year. 8,000 second year's future value for second year. 15,000 is the future value for the third year. 7,000 is the future value for the fourth year, and 3,000 is the future value for the fifth year. Point number one. Point number two, once we have figured out the future cash flow stream, the future uneven cash flow stream for each year, the second point is that we are converting the future values against a required rate of return, or the bare minimum, the discount rate, or the hurdle rate, that is a 10%. So against a required rate of return of 10%, we are reducing each and every future uneven cash flows across n number of years to their comparable values of the present. So the third point is what? In the first point, we took the future cash flows for each year. In the second point, we discounted them against the required rate of return. And in the third point, what we are doing, after discounting, we are getting the individual present value of all the years for 5 years. After dividing 12,000 by 1.10, 8,000 by 1.10 for second year, and so on and so forth, we have reduced the future values to their comparable present values. But not until we add up all of them, because if we don't add up, what will we get? If we don't add up, we will get the present value of each year individually or independently, which is of no use. So in order to assess the sum total of the present value of the future cash inflows, we need to add up each and every present values of the future, so that we arrive at one lump sum present value of the future stream of the uneven cash flows. Point number 3. Now point number 4, which is very important. After adding up, what exactly we are getting? Okay, after adding up, we are getting 35,425 USD. It is the present value. But conceptually, what does it mean? It simply means that this 35,425 USD represents the present value of the benefits, as if, please mark my words, as if this benefit has been received in the same year in which the cash outflow is giving effect to, or the same year in which the asset is being purchased. Be very careful about this thing. This is not happening actually. This is happening hypothetically. In actuality, in the real life, we shall be getting the cash flows across the first year, second year, third year, fourth year, and fifth year only. It won't be possible that just for our sake of convenience, we start getting the entire benefits in the same year itself. If that had been the case, then capital decisions or capital expenditure would not have been qualified as a capital expenditure. It would have been treated as revenue expenses only. But that is not the case. That is the reason why we take the long-term assets into the balance sheet. We charge depreciation as per the matching concept, and then we try to see that every year how much revenue is being generated from the asset, and against that revenue generation we subtract a particular portion of the used asset, that is known as a depreciation, so as to be in consonance with the matching concept. But actually the assets shall be generating the cash inflows only for the number of years for which its economic life is expected to deliver. But the moment we are converting the present value of the future cash inflows, and the moment we are adding up each and every present values of the future, then we are arriving at a whole bundle. We are arriving at an entire amount of the present value of the future cash inflows, which will be giving an effect that, as a hypothetically, as if 20,000 USD is being commissioned, or if 20,000 USD is being paid in T0 only, then if it would have been possible to receive the benefits in the same year only, then the sum total of the future benefits would have been 35,425. So obviously it goes without saying that the cost of an asset is much below the benefits, or the other way around, the benefits are exceeding the cost. Therefore the 15,425 is the net benefit which is being obtained by the firm. Now why did I say that this net present value creates a value? It is creating an example. Now the explanation is quite simple, because we have seen that the moment we have added these individual numbers, that is the moment we have added the present value of these individual numbers, it means what? We have reduced 5 year against 1 year. We have reduced 1, 2, 3, 4, 5 years against the present T0. That means the 5 years future is being reduced back to the 0 years of its present. So it means that when, after reduction or after converging the entire future of 5 years back to the T0, if we are getting a positive result, or if we are getting a positive benefit of 15,425, it means what? That for the next 5 years the asset is going to give us a positive result. Now, this 15,425 is the net benefit, or it is the net value which has been added by the asset by its estimated revenue which the asset shall be generating for the next 5 years. So the estimated revenue, once again I'm using the word estimated revenue, the future estimated revenue which is expected to last for all the 5 years, that has been reduced to its present value, comparable present value, and then after making the comparison we are finding that 15,425 is the net benefit which shall be expected to be generated from this particular asset by its expected future values which she shall be generating for the next 5 years. So after converging the 5 year, after reducing the 5 years back to its present value of T0, then after comparing the present value of the future cash flows against the present value of the cost, we are finding that 15,425 is the net benefit which we shall be getting for the operations across 5 years. That means for the next 5 years, the asset is going to be beneficial, and if the asset is really creating these cash flow, generating these cash flows for the next 5 years, so we have already estimated that such an asset is profitable. Why? Because with the help of the discounting method, with the help of the present value method, we have converted the future cash inflows to their present value, and then after comparison we are finding that 15,425 is the net present value or the net benefit which is being created for the asset. So for the next 5 years the asset is going to be beneficial for us. Hope this discussion is clear with the student. If you understand this thing very clearly right now, I can assure you that while discussing the actual capital budgeting decisions, things will be very, very lucid and very, very simple. Now once again, before signing off, why we are saying that this is a net present value? Because the gross present value is 35,425. Once again students, 35,425 USD is the gross present value. That is a GPV. It is a gross present value or the gross value of the present value of an asset. Merely by looking at it, it will not give us any help. Merely by saying that 35,425 is the present value of the future benefits, this is an half-baked concept. Because if you say that the 35,425 USD is the present value of the future benefit, it doesn't make much of a sense. Yes, it is the present value of the future benefit, but then what? Merely having a gross present value of 35,425 won't establish the viability, or it won't put up a case in favor of the asset. So the case goes in favor of the asset only when we are finding that from this gross present value, can we subtract the cost of the asset? And if the answer is yes, if we say that yes, the gross present value of the asset is more than the cost of the asset, then only we are having a net present value of 15,425, which is a positive amount. It means the gross present value of the asset or the gross present value of the future estimated benefit is more than the cost of the asset, which is thereby leaving us a corpus of 15,425, which in itself is the present value of the benefits which shall be expected to be earned for the 5 years down the line. So going by this explanation, we can say that this is a strong case in favor of the asset. The finance manager should purchase the asset. He should invest 20,000 USD at T0 in order to buy the asset. Hope this discussion is clear, student. Thanks for your patient listening. In the next session, I shall be talking about something even more interesting. Thank you. Happy learning.